Hey everyone. So we're here to talk about corporate taxes for Bitcoin, and on stage, I'll let them introduce themselves, but I'm Jeff Rundlet from Cryptio. Cryptio is a subledger that supports digital asset companies in doing their financial reporting and tax reporting.
Rob Massey, I'm at Deloitte, tax partner. We have been serving blockchain digital asset companies since 2012. We serve throughout the ecosystem across tax accounting, audit, risk advisory, and consulting, but I'm on the tax side.
Tim Savage here. I'm a tax partner at Weaver. Have been with the firm about 6 years and run our digital assets practice. Prior to Weaver, was at Ernst & Young, based in Dallas, and have a wife and a 1.5-year-old, and expecting a baby girl in October.
Must never sleep.
Sleep is scarce, but I have enough time for golf, though. So.
Perfect. There you go. Gavin George, I'm with Tax Network USA. We have been working with companies, helping them build companies in the crypto space, fix crypto problems. So we have to understand tax inside and out as far as... we'll talk more about that later, but we're having to just keep up to date with the changes that are occurring consistently.
Thanks, guys. So we're here to talk about all the relevant new stuff around taxes. We're going to talk about fair value. We're going to talk about the new broker regs, talk a little bit about mining because it's a big presence here. So we'll start with fair value. The new fair value guidance from the FASB came out late 2023. We see companies now coming out and transitioning to fair value. Soon they'll all have to be doing fair value reporting. So we'll talk about some of the impacts from the tax side. So Gavin, can you tell us a little bit about how this works and how it compares to the current?
Sure. I'll let them finish screaming for a moment. But basically the way the fair value accounting is working is it's basically spot checking every time you buy, sell, and making a transaction. It's actually going to end up, it's mandated by the IRS and the new regulations that they're issuing. They're final regulations, which I promise will not be final. And if you don't actually adhere to it, they're going to default to FIFO, from what I remember, right? No, go ahead.
Well, you could pick your inventory management from what I understand, but from the tax side, I mean,
right.
you guys.
I mean, I think the fair value accounting, before we get to the tax piece, is remeasuring by most companies what is the value from an accounting perspective before you get to tax. And maybe one of the big takeaways is if you are part of that standard, and not everybody is, but if you're fair value adjusting on the balance sheet for GAAP purposes, that may or may not be a realization event for tax. So some companies do mark to market for tax, most do not. And so tax wouldn't follow. So if you have financial statements, while they're fair value accounting for GAAP purposes, you might have deferred taxes as part of your provision because tax wouldn't follow. So I think that's probably the new topic that we should be aware of.
Yeah, so let's talk about deferred taxes. It's an evolving regulatory landscape. So Tim, how do you think companies should approach deferred taxes from accounting?
Yeah, so maybe just to set the stage and preliminarily kind of declare that there's GAAP accounting and tax accounting, which are two very different sets of rules. And GAAP accounting is what most public companies and your larger corporations primarily are reporting their financials under. So if you pull up MicroStrategy's 10K or Marathon's, Riot's, these are going to be on GAAP accounting standards. And ASC 740 is a GAAP standard that kind of is the marriage between tax accounting and GAAP accounting. And its intention is to smooth out the tax expense that hits out P&L and what you call the effective tax rate. So, for example, take a public miner who goes and buys $1 million worth of new fleet. They put it in service and deploy it. Tax accounting rules are generally going to make use of accelerated depreciation, whereas GAAP accounting is going to depreciate much more slowly. And the result is differences in the basis of that fleet, those assets. And this is where ASC 740 comes into play, is now you have, you actually capitalize as a deferred tax asset or a deferred tax liability, the difference in that base. And again, it kind of smooths out that effective tax rate. And so to the point earlier, the new fair value standards are interesting because it They're a very welcome set of standards and makes sense for this type of asset class. But for tax purposes, you might have deferred tax assets on balance sheet that are maybe valued down just in current economic and kind of financial situations. And I think the key takeaway is controllers, CFOs, stakeholders may not be aware of that.
What are some of the biggest challenges you see around this the companies are facing?
Well, I think it's the expectation that fair value accounting is going to be great because now I can mark up my assets for book purposes, and that's great. But again, for tax, you might have this DTA on the books that you would think, hey, I can actually use maybe a net operating loss or something like that, or a tax credit. But actually, by ASC 740 rules, without getting too technical, you look at how all of your assets are going to turn over time and how income is projected. And often right now what we're seeing is these companies will not be able to realize that DTA, so then they devalue it. They book what's called a valuation allowance on them.
And the valuation allowance, really, you would start with, okay, my deferred tax asset, as you said, do I have the ability to realize that asset? Depending upon how you hold the crypto, if it's a capital asset versus an ordinary asset, you get to two different answers. And so if you're just holding it on the balance sheet for investment purposes, you have a capital asset, you have a DTA, your valuation allowance would be predicated upon whether or not you have a source of capital gain income to offset that loss. Otherwise, you would have a VA against it, and then you don't have the smoothing you mentioned. So the character piece of this is really interesting, and so a lot of companies need to now take that extra step. Am I holding this for investment purposes or business purposes? And then that translates through a lot of things, including the new regs that we just got, which are only applicable for capital assets. So there's a lot of reasons that character matters.
Okay, thank you. Any more you want to talk about the character and the valuation analysis?
I mean, it's just a critical step. I mean, we see there's a few companies out there that you're watching this happen, where all of a sudden they're fair valuing it for the first time, and nobody's catching this nuance in the character treatment, and they're just saying, oh, it's like working capital, it's fine. But when you really dig down into the rules, it may not be that simple. So it's the right time to pause and say, what is the right rule to govern the character, and then go from there.
Yeah, I believe you mentioned not a lot of companies are truly thinking about this. It's something they often overlook.
Too many instances of people sprinting right past it, and you just got to pause and say, okay, before I do any of this stuff, what is the character? And you may have some of it that's used in the business for reasons, and if you want to nerd out, it's section 1221A, right? That's what it is. And that's if it's used in the business, then you might look at those standards in the case law. If it's held for investment, it'd be something else. But you really start with character and then get into the mechanics. But it's a thing. More and more companies have this on the balance sheet, so something to pay attention to.
Yeah, recently the PCAOB and by extension the SEC has been on a tear for any audit firm, basically any public company and how they're reporting. And so again, while the fair value standards are wonderful and make sense from a just concept perspective for digital assets, don't get too far ahead of yourself and skip over the deferred tax concepts.
Thanks, guys. So we're going to transition to the recent Treasury regulations. They've come out and taken a stance and had a couple iterations on broker regulations. And we'll talk a little bit about that. But Gavin, can you explain the nuances of how brokers need to track the basis?
Yeah, I mean, they're going to be locked in on the fair market value of any transaction at any given time for an extended period of time. So for traders, I think it's going to be really oppressive, just throwing that out there. However, in general, the biggest transactional change I've seen is, at least on my level, is people with small funds are going to get hit with, usually you'd have to issue something like a 1099-B, but it's just a dull instrument at this point, right? There's going to be a digital asset 1099 that's issued, and it's going to have a lot of information on it that you didn't expect, including transaction IDs, et cetera. So it's going to end up, again, I think it's just a chunk of information that's, to be quite honest with you, if you're a Fortune 500 company, it's not a problem, right? I had a kid come to me today, who wants to start a fund using crypto. He's got money, he's got people. It's just the amount of reporting he's going to have to be in charge of. He's 25 years old. Yeah, he's got some money. What the hell is he going to do, right? Like, he doesn't even know where to start. You know, didn't go to college, nothing. He just has a bunch of money, did a great job, knows how to raise cash. And so I'm concerned that the reporting, just from a personal standpoint, is going to be too oppressive for the small guy. So even though we're talking about institutional overall, some of these are small institutions. You know?
How does this differ from the typical securities broker requirements?
You know, as far as the securities broker, this is, I mean, we've had securities brokering for over 100 years, right? So all of that infrastructure is already well designed. It's very efficient. I think there's still a lot of gray area, even though they've tried to issue some final regulations, where some of this information is still going to be evolving as we go forward. That's why I said these regulations aren't going to be final. Even if they issue a digital asset 1099, it's all going to change. It's all going to change. And how do you consolidate all of that information onto that one reporting, right? And then, even then, you have the reporting that has to occur on the institutional level. Then you have the reporting that has to occur from the taxpayer. And if they don't align, now you're putting yourself in audit territory if an agent actually started taking it apart and looking at it, right? So it's, I still think there's some dialing in to do on that level. But you know, I'll let you continue. But it's just frustrating for me. Right?
Yeah,
I don't think they're there yet.
I might have just a little different take, and no doubt it's hard and it's confusing. The Treasury regs that dropped a month ago, think about them in three pieces. There's one for the broker, which lends to the 1099 piece. That turns on the reporting for gross proceeds starting transactions on or after Jan 1. The basis tracking starts on or after Jan 1 26. That's one piece of it, was the 1089 piece and the reporting there. No doubt it's confusing and it's going to be clunky, and it may not be perfect for a while because there's other pieces of this that were not clarified. The other piece of the regs, which is quite instructive for everybody, is the basis tracking rules. And this was clarified, and people have been wanting to use Spec ID versus FIFO. I mean, go back to the beginning of when this all started, and they're making analogies to crypto as it compares to traditional securities and FIFO versus Spec ID. And there's been a wide range of applications. So what the Treasury regs did, first in proposal form, there was 40,000 comments that was levied. Treasury actually took them and compartmentalized those comments. And I think it was a really thoughtful manner. Still hard, to your point, but very thoughtful to how do these dynamics differ from traditional securities. Things like, if you're on Spec ID and you're trading in traditional securities, you have until the date of settlement, typically 2 days later, to ID that asset. Treasury Department said, you know, this is different. Settlement happens really near time, so it's hard. But they said, because of that, we need you to ID on the front end. That means you need to see it's this tranche versus that tranche before the trade happens. It's hard, but that's the rule. And at least we have clarity, because Spec ID really matters in a world where if you're an OG, you've got like super low basis, $80 basis Bitcoin all the way up through the 70s. You really care about Spec ID and which one you're using. So it's very instructive about how it works within the wallets. Can you ID within a wallet or an address? Yes, here's how you do it. The differences between self-custody and custodied assets. So while hard, at least it's clear. And so if it's worth a bunch of money, we have a roadmap. And you can go back to FIFO, but the concept of global FIFO between addresses, that may not work. You may need to think within the wallet. So while hard, while clunky, at least we have rules. And that's a nice place to be, because there was just too much range before. And then when you're under exam, it gets pretty frothy. And so now you've got some guidance out there. And so anyway, that's the way I tend to think about it, is like, this is nice.
Yeah, clarity's nice in this industry. So another hot topic is safe harbor provisions. In the Revenue Procedure 2024-28, for reallocating unused basis among digital asset wallets and accounts, impact broker reporting obligations and taxpayers. So how has this impacted them?
So what the RevProc did, I think about this as a gift. And if you have decent books and records, or even if you didn't, you know your total basis, you know sort of the places it sits, but you don't know, you've not specifically tracked how much basis would attach physically to every digital asset, every Bitcoin and every address. What the RevProc says is, hey, we know not everybody's clean. You have from now to Jan 1 to clean it up and rebuild your support for what basis, your unused basis, attaches to each tranche in each place, self-custody or custodian, and say where it sits by Jan 1, and you make this attestation and you start from there. Then you got to get that to the brokers. Now the brokers, they don't have this obligation until Jan 126. So you need to restart it, give them that information, and now you need to track it. The burden's on the taxpayer. So heavy emphasis on books and records, but it's a nice gift if you don't feel like you have a good starting place. So it's good.
Sure. And Tim, what's your take on this?
Yeah, I mean, I certainly agree. It was a gift. And if you look at the timeline of when the regulations came out, you had August 2023, a whole set of proposed regs, which were extremely comprehensive. And then the final commentary period, 40,000 comments, and then the final regs just dropped like a month, 6 weeks ago or so. And by gift, this whole safe harbor approach was not included in the proposed regulations, and at least for me was unexpected. Deloitte may have known a little beforehand, but yeah, I mean, it's great because let's say you're just a common investor or a trader and you have 4 different Bitcoin wallets. You've been shaving some off here or there, or even paying for things. Under the old notices and rev procs issued previously, some people thought you could use a universal approach where maybe I'm on like a FIFO basis across all my wallets in aggregate, or even Spec ID. But now these regs say you've actually got to do it on a wallet-by-wallet basis. And that changes some of the accounting and how you calculate gain and loss. And now we have 6 months until January 1 of 25 to go and reallocate and use a quote-unquote reasonable method for forming, allocating basis among your wallets. So that was a gift to the industry.
So all that being said, how should companies adapt their books and records to make sure they can comply with these tight deadlines? Rob, you want to take this?
I mean, we're recommending a hygiene check and say, what are your normal processes? Who's involved? What's the roles? Where does software fit in? Where's your broker? How much is self-custody? Take a fresh lens at it and say, what are the flows? And then how do you build in new processes? How much do you care about Spec ID? How burdensome is it going to be? Should you revert to FIFO? And then what do you want to do to protect yourself reasonably? I mean, this is hard. But start with what's natural for the business. Build the support. Make sure that the software vendor you're using and the broker have the right way for you to document and say contemporaneously, real time, it's that tranche I'm using. And if you have disparate systems, those all have to talk to one another. So I think it's a joint effort between the taxpayer and the user to support those books and records, then make sure that your processes marry up with the expectations of all the other software vendors in the mix, including Cryptio, right? I mean, all of us have to work collaboratively to make sure it works per user, because we're all thinking about it a little bit differently. We're all using it differently. But it's on the taxpayer and the software, I think.
I mean, what we've seen with Spec ID too, it's difficult to scale to do true Spec ID. I mean, you could do a modified Spec ID, but it's not an easy scalable solution.
And we have clarity now in the rules, and they're very clear in the rules. If you're not following Spec ID, you're going to FIFO, and that's going to hurt. Probably. I don't know when you entered, but yeah.
Yeah. So that wraps it up. Unless does anyone have anything else they want to share on these new requirements?
I don't know, I'm fixing a lot of problems from round tripping right now when people leave the platform that they're on. Things it's been my day today. There's people coming up. Well, I moved it to this wallet and things like that. And the problem is with custodial I'm glad we have some regulations to say this is what it is. At the same time, cross-platform, it's going to be a whole other accounting solution that you're going to need. I've got people moving them from Coinbase to a cold wallet to a different cold wallet to a different country's exchange to all this. And it's like, how do you piece all of these together in a way where they're easily reportable, cancel out, can you carry over basis? What can you do to lower your tax bill so you're not just wasting money on fake tax bills? You know what I mean? Anyway, it's nice to have some regulations. I think we still need to really isolate how they're going to affect the industry across multiple platforms.
Yeah, I'll take a minute to shield Jeff's company. I mean, there are good companies popping up that are very well experienced, significant talent with development who are building amazing products that, yes, nothing is perfect, but certainly help our jobs and in calculating gain and loss. So, yeah.
Thank you, Jeff.
Appreciate that. Thanks, guys.
We need this stuff.
And there's more rules coming. Treasury did talk about the requirements between brokers to make sure that they're talking back. We don't have those yet, but 6045 Cap A, if anybody wants to read it, that'll be out soon. which tackles some of it, but still hard. And the burden's still back on the taxpayer to make sure that you're following it. And so this comes back to the data flows. Because under exam, if it's something you care about, you need to go back to the data and make sure you have all these books and records set up. So a lot of it comes to the software companies to support us so we're not all manual.
Yeah, well, thanks for that. So we'd be remiss not to talk about the mining industry and the specifics of that. They're the backbone of the industry. They pick up the whole Bitcoin industry in general. So Tim, how do mining companies think about their revenue streams?
Yeah, great question. We work with a ton of miners since we are a Texas-based firm. Obviously, a lot of mining happening in Texas. It's my particular passion just as a tax accountant. I just love working with them. Unfortunately, I feel like the current set of treatment is a little outdated. I mean, miners basically, as you mint blocks and recognize mining rewards, that's taxable income upon receipt. That dates back to a notice back in 2014. And I think it made sense back then, but that predated the rise of commercial mining, where you've really got these big companies and large publicly traded, well-capitalized companies who are building business models around this. And, I've been a big advocate for capitalization of their mining rewards for quite some time now. And I really feel like if you look at the nature of their business model and how they operate, what their intent as a business is, capitalization makes a whole lot more sense.
Rob, do you have a different view on that?
Well, I mean, we got the notice. Now, notices are very low levels of authority, but it makes sense, and it is the only piece of authority we have on mining at the moment. And philosophically, you're right. The business model, like, does it lend to a different treatment? Maybe. And so I think, but you can look at it two different ways. You can say, what does the philosophically make sense? And then you say, do we have any rules in place that would call something different? And so first of all, I'd say, unpack the mining rewards into two different things. So one is you have the Coinbase transaction, which is the property that's never existed before, and then you have the transaction fees. And so you say, okay, well, are those two different things? Technically, yes. And maybe from a tax perspective, yes, as well, right? Because the transaction fees did originate with another party. Those existed, transferred to me if I'm the miner because of some actions I performed. That feels different than if I minted a Coinbase transaction for the first time. So a little bit different in the way we would bifurcate those. Now, again, we don't have any guidance on that. It's just, mining rewards are taxable, and that's sort of the deal. But it feels like that's what should come next, and I think that's what a lot of people are doing is splitting those apart. And then if you want to take a different position on, what are your Coinbase transactions for transaction fees, I think that's where there's maybe some range of motion in the rules.
Yeah. I mean, no doubt there is the pre-programmed algorithmic mining reward, and then there's also the transaction cost. I just feel like if you look at, well, let me back up. If you pull up, Marathon's 10K, they're going to talk about how a miner is providing services to the Bitcoin network, or at minimum to a pool that they operate in. And I can see both sides of the coin. I understand that. I think, again, you can draw a lot of similarities to mining being a commodity producing company or business activity. And if you go to the mining stage, you'll hear them talk about that all day. We're commodity producers. And I think mechanically speaking, within a UTXO, yes, there's a transaction bid that moves from wallet A to B, and the miner takes a piece of that. But again, I don't really see this as a service business. There's no regard to the customer. You can't undo a block. The customer is not hiring a service company. They don't care who mines it. They just want it mined. And that's kind of in line with Satoshi's game theoretics and how the whole algorithm was designed. So I feel like even the transaction cost, there should be consideration as to should that be capitalized just by nature of there's been nothing like this before. So, should the mempool really be considered like a pool of resources, of commodities where the UTXOs are just kind of repopulating that, and the miners are hashing, find a nonce, and then boom, they can access the mempool, scoop up transactions, and call that inventory.
I totally agree with you. I mean, this is a true test of tax principles on these innovative business models. I mean, you can't really find another example quite like this before, where you're actually earning the right through your actions to produce something new, right? And it's even different. You can draw distinctions from staking, whereby you have the inherent right in the asset you hold to perform those actions. With Bitcoin, you really don't, right? You're just performing those actions. So it's a real test. We should probably get some more guidance on this because, to your point, the character matters. What is it? Is it a service? Is it just general accession of wealth? Because from a sourcing perspective and all the other benefits like FDII and GILTI, you really need to know what is the character of these transactions. To just say it's income is not the end of the story. You need to know what it is because it ends up impacting the other tax provisions and positions out there. So it's time to unpack it. I don't know where it is on the roadmap, but it should go beyond the notice.
Hey, Jeff, can I? Hey, I just wanted to interject really quickly for anybody who doesn't understand what we're talking about. When you mine crypto, now it's not even specific as to what kind of crypto it is, right? You're taxed when you receive the reward, and then you're taxed again when you sell it, right? But you're taxed on the capital gain between what the fair market value of it was when you received it and what it was when you sold it. The only reason this exists, in my opinion, is because guys will hodl. They'll just hold on to crypto for 5 years if they're mining it. And so the IRS wants to, get what they can get, right? So that's why they're issuing this. They're trying to, in my mind, it's double taxation, but we haven't really figured out how to avoid that holding problem, right? Otherwise, I mean, imagine you're mining gold, right? You pull it out of the ground. Is it taxable when you found gold and melted it down? Or is it taxable when you sold it? If I have an orange grove and I grow a bunch of oranges, is it taxable when I pull the orange off the tree? Or is it taxable when I sell the orange? Right? So what they're saying is the mining reward is actually income. I don't think that's fair, and I end up having to unwind a lot of messes for people who are experiencing this, and they go, wait, why am I being taxed twice? Is it taxable here or is it taxable here? And the answer is yes, right? So I'm trying to figure out how to avoid that. It'd be nice if the IRS would help out a little bit on that. Like, they need to meet us in the middle somehow.
Yeah, and I mean, to tie it back to the whole ASC 740 concept, a lot of companies have been running tax losses. We call it a net operating loss, and basically it's an expense that you can use in the future, probably valued down. So they're not super concerned with it right now, but assume, number go up, and one day they start cash flowing significantly. They're going to start caring when they have a tax shortfall and ultimately a cash flow liability when they could have gotten in front of it and thought about this a little bit at a more intellectual level.
I like your idea of capitalization, by the way. I think if we're able to lock that in and have a clear schedule that moves forward on what it is we're carrying forward, I think that's going to be a really strong position, as long as they can keep track of it, right?
Well, thanks, guys. We're out of time, and thank you everyone here that is not looking at RFK right now, and thanks to everyone on stage.
We're going to need you to cheer louder than they are.
That's right. Come on, whoop it up.
Thank you. Anybody else? Help me out here. Yes. We're going to make all of them jealous. Thank you.